buying real estate with an IRA and a non-recourse loan. Before I get too far, obviously I am an attorney, so I'm going to do the attorney thing here and give a disclaimer and also just tell you a little bit about me. Just keep in mind the information here is meant to be educational in nature, and we strongly encourage you to seek out professionals, attorneys, accountants, or the real estate investment professionals when carrying out actual transactions. And keep in mind that this presentation does not constitute an attorney-client relationship. Just a little bit about me. I'm a partner at the law firm KKOS Lawyers. KKOS Lawyers is a law firm with offices in Arizona, California, and Utah. I am in the Phoenix, Arizona office. I'm also the author of the book, The Self-Directed IRA Handbook, which is a heck of a good book. It was an Amazon bestseller. My book beats out books like by authors Brian Tracy and Susie Orman in the same category, in the retirement planning category. It's the most widely used book already in the self-directed IRA industry, and I do have a 5-star rating, higher than the iPhone 6. Just saying. But you can find my book on Amazon, all kidding aside. Also, it's on my website, sdirahandbook.com. Roger, I don't know if you want to read your own disclaimer here. I'll let you have that honor and privilege if you'd like.
I sure will, Matt.
All right.
I really want to thank you for the opportunity today to help educate all you out there on the call and the webinar on non-recourse lending and how it relates as well to putting real estate in your IRA. I'm the Senior Vice President of First Western Federal Savings Bank, and First Western Federal Savings Bank and its employees are not accountants, nor are we qualified investment advisors, and we don't provide advice on IRA rules, regs, and eligibility requirements. And I would ask you that you consult with your tax and investment advisors. First Western Federal Savings Bank is a nationwide non-recourse lender, and we lend in all 50 states to investors like you who are buying property with your self-directed plans and want to leverage the purchase with some loans. So that's our role. That's why I'm here today to tell you about non-recourse lending from the bank side of the desk. So I'm here to help, and I'll tell you all about our product and how it works for you.
All right. Well, thanks, Roger. You know, this really is a niche industry for those of you who have been out there and, you know, may work in the industry or be investors in the industry. So it's rare to find a banker that's familiar with these rules and has loan products available as well. So thanks, Roger, for joining and helping out with this.
Absolutely. And I've read your book, Matt, and it's awesome.
Thanks. All right. Well, let me go over what we're going to cover today. I just want to give an outline so people know where we're going. Because of the large amount of attendees today, we will not have time to take questions as we go through the material. I'm going to try and take questions towards the end, but I have to tell you this webinar is jam-packed with information, and I'm really excited actually to go through some of this stuff. A lot of new stuff in detail I have never even taught before, and I speak on this stuff so much. It's just, I mean, I'm always out there talking and teaching in this area, so I'm really excited to go over some of these details today. But we'll first talk about just how a self-directed IRA invests into real estate. I'm going to go through that part rather quickly. I believe most people on this call are likely familiar with it, but for those who aren't, who are new to what is a self-directed IRA, how does it invest in real estate, I'm going to give you the Reader's Digest version. We'll talk about why you must use a non-recourse loan and what that is. Roger obviously is going to get into much more detail on the loan terms for a non-recourse loan, options, lending requirements, property analysis to get a non-recourse loan on a property that your IRA may be purchasing. And then we'll finish up and I'll be talking about UDFI tax. That's unrelated debt financed income tax. That is a tax that can apply to your IRA if it purchases property leveraged with debt. And then we'll finish up with pros and cons and really look at the analysis of what we covered and talk about whether it makes sense to buy property with an IRA using a non-recourse loan. So that's the big picture, and really excited, as I said, to get into some of this detail here. But before I get into the detail, I just want to give a little preface here on why are we talking about this. Self-directed IRAs have become a very growing industry, and people investing into real estate with self-directed IRAs has grown significantly over the last 10 years. I started helping clients back in 2006 in this industry, and from that time till now, it's amazing how quickly the growth has happened. There's a couple reasons why we're seeing so much growth in this industry. One is that's where all the money is. Okay, there's $23 trillion. This is a graph here that ended on 2013 numbers. There's $23 trillion in retirement plans in the United States right now. And as the baby boomers are getting older, they're leaving employment or they're retiring, and they have all this money in retirement plans that they're rolling into self-directed IRAs. One of the most common investments from a self-directed IRA is to buy real estate. A lot of people are fed up with the stock market, or they just don't understand it. They want a more tangible asset, whatever the reasons may be. Maybe they're a real estate investment professional, and they just know real estate more than they know mutual funds. I don't know. But there's a lot of growth going on. There's a lot of dollars moving into it, and retirement plans have become the largest concentration of wealth amongst American families. So it's no wonder as those retirement plans are being freed up by people, particularly the baby boomers right now, that we're seeing this huge growth into self-directed IRAs. All right, let me talk about what a self-directed IRA is here quickly and why people use it. A self-directed IRA is really just an IRA where you have a custodian of that IRA that lets you invest into any investment allowed by law. Now, IRAs have always been able to invest in invest in real estate. That's been, ever since IRAs were created, you've been able to do this. The reason most people don't, or that they've never heard about it, is because most providers of IRAs are broker-dealers or financial institutions. And what do those companies sell? They sell financial products. So they don't handle real estate transactions. That's not because IRAs can't own real estate or any legal requirement. That's because they just don't sell those products. So real estate can be purchased by an IRA. The trick is you must have an IRA with a custodian who allows you to self-direct. And these sometimes are referred to as self-directed IRA custodians. So if I have an IRA, for example, with Merrill Lynch, my Merrill Lynch IRA can't buy real estate. And that's not because of a legal requirement. That's just because Merrill Lynch doesn't let you buy real estate with an IRA. That's their policies. So you'd have to roll that IRA out to a custodian that does allow you to self-direct. You move it to a self-directed custodian, and they'll let you invest into any investment allowed by law, whether that's real estate, a startup company, a venture capital investment, private equity, precious metals. There's a lot of options out of the Wall Street mainstream typical investment choices. So this diagram here shows how that would work. If you have an IRA, it can purchase real estate. The IRA would be the owner on the property. The IRA is on the deed. So, for example, it's not Matt Sorensen that owns the property. It's ABC Trust Company, Matt Sorensen IRA. So my custodian is on the title to the property, for example, and my IRA owns the property. I don't own it. So when there's rental income, that goes to my IRA. When there's expenses on the property, my IRA pays those expenses. Now, the IRA can only take money out. You can only take money out of an IRA by distribution. So you can put money into an IRA by contributions, or you could roll over money to an IRA. But the only way you get money out is by taking a distribution. So if you're making money in an IRA, rental income, or you sell a property for a profit, that money goes to the IRA. The only way it comes out is by distribution. Now, why do people want to use a self-directed IRA to invest in real estate? Because there's no tax on the gains. So just like if I bought Coca-Cola stock for $50 a share and sold it for $75 a share, when I do that with an IRA, there's a $25 gain per share on that sell of stock. But because I did it in an IRA, there's no tax on the gain. That's one of the great tax benefits of an IRA. If I bought real estate at, say, $50,000 and sold it for $75,000, and I did that in my IRA, I would similarly pay no tax on the gain because it was in an IRA, and you're getting the benefit of the IRA rules. So that's one reason people will use a self-directed IRA, is because of the tax benefit. Another reason, frankly, is that's where they have money to invest. Now, in addition to using an IRA to buy real estate and having your IRA own real estate directly, some people will have their IRA own an LLC 100% and then the LLC will own the rental real estate. I'm going to go through this explanation here pretty quickly. I do have some videos on this to go into more detail. If you're interested and this goes over your head, just shoot me an email. And my email is Matt, M-A-T, at KKOSlawyers.com. It's on the slides. But what will happen here is the IRA will own 100% of the LLC and invest its cash into the LLC. You'd instruct your IRA custodian to invest that cash into a newly created LLC. This is a special purpose type of LLC. The documents are very different than your typical LLC out there. This is something our office can help set up. We set up a lot of IRA LLCs for clients. Fees for that type of an LLC are around $800 plus state filing fees. That LLC in turn will go out and buy the property. Now when the LLC buys the property, now the LLC is on title to the real estate. And as manager of the LLC, the IRA owner can be manager of the LLC subject to certain restrictions, but as manager of the LLC, you, the IRA owner, have a checking account you can manage. You can sign checks to buy the property or pay expenses. You'll receive the rental income in the LLC bank account. Now you can't use that money. That's your IRA's money. You'd have to send it back to your IRA and take a distribution of the IRA. But you can manage the LLC bank account and income expense, and that's a big benefit of using the IRA LLC. You can also, hire contractors or sign contracts on the property as manager of the LLC. Now, the reason I want to show that is because for many of our real estate clients who get a non-recourse loan and use a bank like Rogers, they will use an IRA LLC structure and use a non-recourse loan. And so what they'll do is put a portion of funds down, they'll invest into the IRA LLC, the IRA LLC puts a portion of money down, and the lender, the bank, comes in with a non-recourse loan for the balance. But everything happens at the IRA LLC level. The IRA LLC is on property, the IRA LLC is the borrower, and obviously the property here is secured by that loan that came from the non-recourse lender. Now, we're going to get into this non-recourse loan thing really quickly here. I just want to make sure people understand some of the basics and common structures that are involved in using a self-directed IRA. And if you are new to this, I know this might be very fast. I want to get into the non-recourse loan details, and that's the purpose of this, this presentation. But some of these items, I do have information on my website as well as in my book for more detail on this. And I also have some videos. If you want me to direct you those, just shoot me an email. All right, now I feel like I brought everyone up to speed. I know that I didn't, but I know we have a lot of people on here, a lot of my clients, and a lot of people who are very familiar with self-directed IRAs on today's show. So let's get into the meat of what we're talking about here and start talking about non-recourse loans and investments in real estate. Now, I want to get into the tax code here and be a little nerdy for a while, but I want to talk about why must we use a non-recourse loan. And it's helpful to understand why the requirement is about and why we have to deal with a non-recourse loan instead of just getting your regular type of loan product out there. There is a type of prohibited transaction called an extension of credit prohibited transaction. And a prohibited transaction is bad for your IRA. If your IRA ever has a prohibited transaction, it means your IRA is disqualified and it's distributable to you. It's a big tax nightmare, so you never want your IRA to engage in a prohibited transaction. But if you have what's called an extension of credit prohibited transaction, then again, your IRA is distributed, you no longer have an IRA. And the way you come about an extension of credit prohibited transaction is if there is ever a lending of money or other extension of credit between a plan, which would include an IRA, and a disqualified person. Now this is tax code lingo. Let me basically summarize this in layman's terms. Whenever your IRA gets a loan to purchase something, let's say it's to buy real estate. You're going to put some money down from the IRA to buy the property, and you're going to get a loan to pay the balance. Whenever there's a loan obtained, you, as the IRA owner, are a disqualified person. So you cannot guarantee that loan, sign on the loan, use your credit to obtain that loan. That would constitute an extension of credit, and you're a disqualified person, so you would have an extension of credit prohibited transaction. Therefore, you want to avoid guaranteeing any loans or using your own credit if your IRA is buying a property. Hence, what's come about is the non-recourse loan, and you want to be careful in making sure you get a non-recourse loan that qualifies for IRA purposes. And what will happen is in that non-recourse loan, now the bank is going to extend a loan, but they're going to secure the loan against the property. And in the event of default, the only recourse the lender will have is to foreclose and take the property back. They can't go back after the IRA. They can't go after the IRA owner. So their sole recourse is to foreclose against the asset they loan their money on. And that is what will qualify as a non-recourse loan. If you use a non-recourse loan, you do not have an extension of credit privilege transaction. So the best way to avoid this extension of credit privilege transaction is use a non-recourse loan. Do not put your credit in or do not guarantee a loan for your own IRA. Now, there are some cases that have been out there about non-recourse loans. There's a case called Peak and Fleck versus Commissioner that went into that, and where the IRA owners pledged their own assets, their personal assets, against a loan that their IRA obtained to purchase something. That was an extension of credit privilege transaction. So just keep in mind, you have to keep your assets separate and your credit separate from the IRA's purchase. Let the IRA buy its asset. That asset could be foreclosed on and lost, but that's it. The personal assets of the IRA owner cannot be at risk. Now, the other thing you have to know whenever you get a non-recourse loan or you leverage your IRA is you must be aware of UDFI tax. It's called Unrelated Debt Financed Income Tax. I'm going to go over this in much more detail. It applies to IRAs. If you have a self-directed 401k or pension plan or profit-sharing plan, employer-based plans are exempt from UDFI tax. But IRAs have to deal with this. We're going to talk about this at the end of the presentation in significant detail, but I just wanted to flag it here. So that is why we must use a non-recourse loan, because of the extension of credit prohibited transaction rules. All right, now I'm going to turn it back over to Roger, and I'll let him get into the loan details, what they look for in obtaining a non-recourse loan in terms of using an IRA. So Roger, take it away.
Thanks, Matt. And to do a little takeoff on what you mentioned, Matt, about no personal liability, that's the real beauty of these loans, is that you as an investor may have 8 or 10 rental properties personally out there and have loans on them with typical Fannie Mae, Freddie Mac lenders. The beauty of doing it through your self-directed IRA is the property and the loan is not a personal obligation, and it does not show up on your credit report. It's completely on a separate business entity. So the beauty is you may have hit the limit in terms of the number of loans you can get with the regular government-style lenders, but there are no limits to how many loans that you could have within your self-directed IRA. It doesn't go on your credit, so it's completely on another business entity, and that's the beauty of the self-directed IRA. You're not liable for the loan. Your IRA is. So let me cover fairly quickly, but I'm going to cover our product offerings so that you people out there who are looking to finance and leverage some of your purchases can see exactly what it will cost and what the program looks like. We write 25-year fully amortized loans in every state in the country, and typically our loan to value is going to be 60%. So your IRA is going to put 40% down, and we're going to finance 60%. And we'll write that over a fully amortized 25-year loan. We've got several adjustable rate products available. We have a 3-1, 5-1, and 10-1 ARM, meaning that on that 25-year loan, the rate is fixed for 3 years, 5 years, or 10 years at the rates you see in front of you. And then once that fixed period is over, then the loan will just adjust once per year on the anniversary date of the note, and the rate will either go up or down, or it may just stay the same. We tie these rates to the one-year Treasury bill, and if the one-year T-bill has not moved since your loan originated or from the previous year, your rate is not going to go up. It'll stay what it is. We also write a 20-year fixed rate for those people who may have some risk aversion to a variable rate loan, or maybe they're going to hold the asset for 20 years and they just want to dial in that rate of return and that interest rate and set it. I would have just say that the bulk of the customers I deal with, though, probably do the 3 or 5 year ARM, simply because it is the best bang for the buck. It gives them a 5-year time horizon where they can basically set it and forget it and move on to the next asset. On the next slide, you'll see that we also lend not only on 1 to 4 family residential properties, but we will also lend on any income-producing real estate. 5 units plus, commercial properties, vacation properties. And if you're buying one of those kinds of properties, let's say you're buying a 10-plex or a condo on the beach someplace, we're going to lend 50%. There's a little more risk to the bank, so we'll have you put 50% down and we'll lend 50% of purchase price. And again, we write a 3-year ARM, 5-year ARM, 10-year ARM, and a fixed rate loan at the rates you see in front of you there. They're very, very competitive rates, and we are, to my knowledge, the only national non-recourse lender that is lending on commercial properties or 5-unit plus residential properties and vacation properties. So we offer a wide palette of loans for a wide palette of properties, whatever your investor appetite is. And we are what I say, a common sense lender. We look at each deal on its own merits, and we take into consideration the merits of that transaction, and it's all driven by the property. We index our loans to the 1-year T-bill, and we do cap the rates on the 3 and 5-year ARMs so that the rate can't go too far out of whack if short-term rates go up high, and so we do cap rates at 2% annually and 6% lifetime on those 3 and 5-year ARMs. The next issue that I see is something to be aware of is fees. What does it cost? Well, typically, as most lender loans you've probably done on real estate, we have a 1% origination fee. In other words, if we do a $100,000 loan, there's a $1,000 fee. Also, there's a $300 processing and $300 underwriting. These fees are only payable at close of escrow. So you don't pay a dime to apply with us for our loan. Only if the transaction closes, you'll pay that origination fee and our other processing and underwriting. You will have, as you can imagine, an appraisal on the subject property that's being pledged for the loan, and we will order an appraisal in the local markets in which the property is located. We don't use a nationwide appraisal service that picks appraisers. We're pretty particular that we only want to use state certified appraisers that have knowledge of how to write appraisals using a income approach and a rent comparable approach. Now, how long does it take to close? We can usually close in about 30 to 35 days. As I mentioned, it costs you nothing to apply. I can typically, if you'll send me a full package, I'll get you an answer in 2 days. If we like your deal, you like our terms, I'll have you send me an appraisal deposit. Upon receipt of that, we'll order the appraisal the very next day and start processing with title work and so forth. Next slide is what do we look at as a lender? How do you qualify for this? Well, as Matt said, you're not the borrower, so I'm not looking at your income. I don't look at your tax returns, your personal financial statements. That's irrelevant. You're not the borrower. Your IRA is the borrower. So what do we look at? Basically 4 things. 1, does the IRA have the money, the 40 to 50% down? I can see that within 1 minute, basically, of looking at your account statement. Okay, they got the down payment. Do they have the closing costs? Yep, and you're going to have closing costs on any real estate like you do in any part of the country. You're going to have your usual title company fees and et cetera. So again, budget for some closing costs. We also want to make sure that there is what I would call an operating reserve or a reserve fund. We don't want you spending your last dime in your IRA to get a property bought, and then all of a sudden there's an issue, or Joe the plumber comes over and hands you a $1,000 bill for a new hot water heater. You can't pay that bill out of your own personal funds. All income and all expenses must flow through the IRA. So if you have an expense on that property, you're going to have that money come out of somewhere. That's the purpose of those liquid reserves. And they don't have to be laying around just in cash, doing nothing for you, earning 0.1%. You can have it in, mutual funds, if you have pet stocks you like, that's fine. We count any of those big board stocks and mutuals and bonds as liquidity because you can turn that into cash in a couple of days, and if you have to write a check for a repair or something, you've got the money. So number one is, does the IRA have the funds? Two, does it generate a positive cash flow? Because that really is what's going to pay the loan back. The property is going to pay the loan back. You're not, as a person, going to pay the loan back. The property is. So we scrutinize that property, and if it throws off positive cash flow to this metric of 1.25 debt service or greater, we're good. A couple other major things. Is the property a good one? Does it make sense for you as the investor? I'd like to go through a couple of examples. These are real-life examples of typical deals that we have done and do every day over here. So let's take the first one. It's a $100,000 residential single-family purchase. As I mentioned before, the IRA will put 40% down, will loan 60%. So in this case, it's $60,000. Let's say you have a tenant, sign a lease with them for $1,000 a month. In order to calculate where that debt service is, we take your gross income for the year, $12,000. We're going to allocate a vacancy factor of 7%, which basically represents 1 month of vacancy per year. That's pretty conservative. You subtract out your taxes, insurance, any maintenance, any management fees, and that will get you down to what's known as net operating income. Gross income minus your basic operating expenses. In this one, you see it's $7,360. The debt service on a $60,000 loan, 25 years at 4 1/4, 3-1 ARM product is $3,900. So you divide $7,360 in net operating income by the $3,900 in principal and interest payments, and that gets you to a 1.89 debt service coverage ratio. Or to put it another way, your net operating income is 189% of your P&I payment. The next one, I have a deal where a customer was buying a condominium. Purchase price on that thing is $184,000. Because it was a vacation condo, they're going to put half down, so the loan amount is half of that at $92,000. The gross rental income for the year amounted to $15,600. Again, we subtract out the vacancy factor. 7% of the $15,600 is $1,092. Subtract out taxes, insurance, maintenance. In this case, there's an HOA fee that you build into your model. In this one, the customer was managing the property themselves, so they didn't have a management cost. So at the end of the day, or in this case, end of the year, they had net operating income of $9,308. You divide that by the annual debt service, P&I payments of $6,373, and you end up with a debt service coverage ratio of 1.46. That is greater than our 1.25 standard, so the cash flow meets the acid test. The next one I'm going to show you is a commercial property, and again, this is a live example. A person with their IRA bought a $600,000 commercial building. There was a triple net lease on that building at $5,000 a month, which amounts to $60,000 a year. We still, just because we're conservative bankers, I build in a 7% vacancy factor, although you're going to typically have a longer-term lease, 3 or 5 year lease with some renewal options. But you subtract out your vacancy. In this case, tenant is paying taxes and insurance, so we allocate nothing to those fields. I did allocate a little bit in there for maintenance in case stuff that the basic contract didn't cover, the owner has to pay for, the owner of the IRA and building, that is. Ultimately, after their management expenses of $4,800, they had net operating income for the year on that property of $47,400, and you divide the $47,400 by the $30,000 and $136 in principal and interest payments, and that comes out with a debt to income, or a debt service coverage ratio, I should say, of 1.57. Again, that's a good deal. the investor's making money, the cash flow is positive, and there's money to pay the loan back. What should you be looking for, and what do we look for? You know, the whole thing on these things is doing your due diligence and taking the time to study the property and make sure it is a good one for you and for your appetite and risk appetite. A lot of times people buy things in an HOA or condos, townhomes, whatever. They're all inside of an HOA. Well, you know what? HOAs are a business entity just like any other business entity, and there's risk. So make sure you ask for 2 years financial statements on that HOA. There's a lot of HOAs that actually failed during the real estate meltdown because they had a lot of owners in there that couldn't pay their HOA fees. They got foreclosed out. You want to make sure you're buying into an HOA that's solid and solvent and not hitting you up with increasing HOA fees or special assessments. So make sure you get the financial statements and a budget. They owe you that as a prospective buyer. If you have a contract, you ought to be able to get that information out of your realtor or the listing agent. Check crime. Make sure that the property you're buying in is one that is free from a lot of crime, because as you know, crime will impact tenants, it'll impact resale value, and the quality of your asset. The condition of the property ought to be rent ready or nearly so. We can lend on a property that isn't perfect. There aren't many perfect properties out there. So if they need a little carpet, paint, a little TLC, that's fine. All we say is, you know, we can close a loan on a property that needs a little bit of TLC, as long as, again, you have the money in your IRA or LLC to make those repairs. We just don't want to lend on a wreck. So something that needs $20,000, $30,000 worth of work, if you really want that property, go buy it with cash with your IRA, fix it up with cash with your IRA, then come back to me and I can do a cash out refi for you. So there's an option if you do want to do a property that needs some extra rehab and want to put some financing on it, and you have the wherewithal to do it, go ahead and get it bought, fix it up, then you can come back to me and I can lend you your 50, 60% LTV on that thing. And then the last thing is age of property. We like lending on properties that were built in 1940 or newer. So as long as in that timeline, that's good. I know there are areas of the country where older homes, particularly back east, is the rule of the day. And if you have a property built in 1910 that's been cleaned, updated, plumbing, electrical are all up to code, we're good. So I can lend on an older property. I just would probably require you to go out and get a home inspection. You may wonder, okay, that sounds pretty simple. Got the money, property cash flows, it's a good property. What are some things that can derail a loan? Well, probably the biggest one I see is people overestimating the rental income they can receive. They say, oh, you know, I can get $1,500 a month. Well, you know, why is your property so special when the ones down the street are renting for $1,200? Or in the case of vacation rental, do your due diligence and make sure that that property truly can throw off $50,000 a year in rental income as a short-term rental. Oftentimes, they don't. And here's the check to your work. When we do a loan and we get that appraisal deposit from you, we're going to order an appraisal with a rent comparable piece. And the appraiser is going to go out and find a minimum of 3 comparable rental properties in a tight geographic area, and that appraiser will then determine via those comps what your property should be able to produce. And where I see people getting into trouble is they say, yep, this thing's going to do $3 grand a month, and they build their model around that. And I take you guys' word for that. You're the big boys and girls out there. You're the investors, so I'm going to do my loan based on $30,000 a year or $3 grand a month, whatever you're saying. Let's say that the appraiser comes back and says, you know, everything around here rents for $2 grand a month. Well, you know what? I got to use the appraiser's number. So now I run all the calculations based on the appraiser's rent comp figure, not yours. So the appraiser is the check to your work. Just do your due diligence, get some data, use your realtors. I mean, they have access to this stuff. Use them to get your accurate numbers, because the appraiser is going to be the check to your work, and the appraiser will overrule. They're the outstanding third party out there that the government says we have to rely on for our loan. Couple other things, buying the most expensive property in the neighborhood. You don't want to buy the $100,000 house in the neighborhood when everything else is selling for $60,000, $70,000 around it. And I'm probably not going to lend 60% of that $100,000 property when you can go down the street and buy something for 60 grand. So just be careful. I know a lot of stuff out there has been rehabbed and fixed up, but even so, you don't want the most expensive property. High crime areas, that's always a deterrent. Poor condition of the property, maybe we go down the line thinking this is a good deal and either the appraisal or a home inspection reveals a whole bunch of stuff about it. You might be able to live with that, but me as a lender, I maybe not. So check it out. Make sure that the property is in good shape. Who can get a non-recourse loan? As Matt said, it isn't really a who, it's an entity. And that entity is any self-directed IRA or any LLC made up of IRAs. It could be a single or multi-member IRA. You could also have an LLC made up of solo 401k members. The key is it's a self-directed plan. And lastly, I'm going to say that there's some really good reasons why this is a good thing to do, and I think just the volume of people bearing it out over the country are doing this are, one, you're getting a hard, tangible asset you can see, touch, and feel, and it doesn't go up and down with the market on a daily basis. It's solid. You can go over there and walk in the door and see it. It's there. It offers some diversification. It's probably not great to put everything in the market or all liquid assets. You should have some real estate as a part of your investment mix. And there's a lot of choices out there in today's market. We've gone through a meltdown, and a lot of properties have been fixed up and back on the market. And there's a lot of choices out there and a lot of opportunities. And prices are pretty good right now. Cash flow is good. So there's a lot. And as Matt mentioned, there's no tax on your rent incomes or your capital appreciation because it's held in the IRA. The only tax you might pay, which he'll touch on later, is UBIT or unrelated debt-financed income. We will lend on any property that throws off positive cash flow with very few exceptions, and that's pretty much any residential property, single-family, multifamily, like I mentioned, apartments, 10-plexes, whatever, commercial. Strip centers, a commercial building, office, warehouse, they're really solid. That's a good investment. We'll do commercial. We'll do farms with income. A lot of people who have ag backgrounds and are comfortable buying agricultural real estate, if you can get a lease on that thing from the farmer next door to that property, that thing cash flows positive, we'll lend 50% on a farm with income. Matt, I think I'll turn that back to you now, and you can explain a little bit about what having debt on a property may really mean to a client that's doing this through their IRA.
All right. Well, thanks, Roger. I appreciate that. That's, we wanted to get into the detail on loan requirements and what the lender's looking at, and really appreciate your input on that, Roger, and your expertise. Okay, well, I am going to jump into the most exciting part of the presentation that I feel for today, because we're going to talk about a tax called UDFI tax, unrelated debt financed income tax. This is a type of tax, sometimes called UBIT, that can arise when your IRA obtains debt to acquire a property. So what we've been talking about today, buying real estate and using a non-recourse loan to fund a portion of the purchase. That can cause this UDFI tax. Now, the reason I'm excited to talk about it today is there's been so much mystery about this, I think, that has freaked out investors who would otherwise use a non-recourse loan to buy real estate with their IRA. But a lot of people gravitate to a self-directed IRA because they want to be able to invest in real estate without having to pay tax. But now you're telling me I need to pay tax? And what kind of tax is this? And it's super complicated? Well, I'm going to try and peel back the mystery here and really show you how it works. And the exciting thing from my perspective is it's not that bad. I mean, we have spent a lot of time going through these numbers. I have some samples I'm going to walk you through to see. I've actually ran 990T tax returns on these, and we're going to show you how the tax numbers actually break out. So you can see if I owned a property with debt on it, how would that work if I rented it? How's that going to work if I sell it 10 years later? I'm going to walk you through some examples. Now, before I get into the examples, which I think are the most helpful in learning this, I just want to go over the basics here first and kind of set the stage of what UDFI is and how you calculate it in a basic sense. If I get to the example here, you might get lost really fast. So let's just go over the basics here. I think one of the best ways to think of UDFI tax is essentially what the IRS is saying is, you know what, we'll let you leverage your IRA's purchasing power with debt, which is non-IRA dollars. It's not retirement plan dollars. But if you do that, you must pay tax on the money invested and the profits generated from it that is not retirement plan dollars. In other words, your retirement plan dollars are going to get the retirement plan tax deferred or tax-free treatment, but your non-retirement plan dollars that are debt, the income you make off of those dollars that are invested into the real estate, you have to pay tax on. And it's almost like what you're doing is when you put your IRA's cash in and then you bring in a loan with that cash, the loan part is subject to tax almost like it's another person. It's another partner in your deal, and the profits from that part of the deal get taxed. So it's not the end of the world, and you are paying tax on the profits that arise from the debt. As you go through the calculation here, we'll get into specifics. Like I said, the tax is not that bad, so don't be freaked out. All right, well, here's what you need to know to calculate UDFI tax. You obviously have to know the income from the property from the year, whether it's rental income you had for the year, and we'll go through a very specific example on that, or maybe you sold the property that year and it's gained from the sale of the property. We need to know the average acquisition indebtedness for the year. In order to calculate this UDFI tax, we need to know how much debt was on that property during that year. And that average acquisition indebtedness helps us determine the portion of the income that is taxable because of the debt. Obviously, the higher debt we have, that's going to push more income being subject to this UDFI tax. If you have a very small amount of debt, then it's a small amount of income that gets pushed into UDFI tax. If you pay off the debt and you don't have any debt for 12 months, after that period, you don't ever worry about UDFI tax, even if you had a loan before. So we need to know the average acquisition indebtedness. Now, don't be confused by the word acquisition indebtedness. The IRS uses that word in the code, or excuse me, I shouldn't say that is the word in the code, but it has been defined to include a seller finance loan. If you bought a property and the seller financed it, it would include a new purchase. It would include let's say you bought a property with your IRA and then got a loan to rehab it. That rehab would fall under this acquisition indebtedness. So really any debt that is going to arise on the property your IRA owns is going to cause this UDFI tax. Then we need to know the adjusted basis for the property. So what was the cost of the property when you purchased it minus any depreciation that happens year to year? And we'll show how that works. So if you take an example of a property, and let's say it's a property you purchased for $100,000, and let's say you sell it a year later for $130,000, so you have a $30,000 gain. But let's say when you bought that property for $100,000, you had $40,000 from your IRA, $60,000 from a loan. Well, when we look at the average acquisition indebtedness, let's say it was $60,000 for that year, and therefore we are going to have, excuse me, let's say that you paid the loan down, then it got down to 50. Sorry, I got to learn my own example here. So let's say you paid the loan down, you got it down to 50 average acquisition indebtedness by the time of sale for the last 12-month period. So your average debt is 50%. You have a $100,000 basis, so you have 50% leverage. Now, let's say you have a $30,000 gain from the sale. Now, when we get that income, the first thing you do is you have to say, all right, how much of this income is being attributed to the debt? And if half of the property was being financed by debt here, then we take half of the income, which would be 50% here, and that portion is subject to this UDFI tax, which would be $15,000. So the other $15,000 there that is going back to my retirement account. I'm not paying UDFI tax on that. After that, you take deductions. So then you take expenses on the property, and you take the same leverage percent to the deductions, and you'll reduce the deductions or expenses on the property by the leverage percent. So in the example here, we decrease the income down here to $10,000, and then you have $10,000 of UDFI taxable income, and you have 20% long-term capital gains rate that is owed at the time of sale. Now there's the tax rate for this UDFI tax or UBIT tax. At the time of sale, you are allowed to use the long-term capital gains rate, which is now 20%. If this is rental income, and you're going to see this in the very specific examples, if it is rental income, you use the typical UBIT tax table, which is the trust tax rate, which is right here. Now, the bad thing about this table is you'll see once you're at $12,150 of income or greater, it's a 39.6% rate. The nice thing is for clients with single-family rentals, for example, we rarely see them getting up to this. And as you see through the example that I'm going to give you, it's highly unlikely you'd get up to this. Really where you'll see someone get hit hard with UDFI tax is if they have a significant gain on a property and they still have a lot of debt on it and they sell it. But in that case, at the time of sale, remember, you get to use the long-term capital gains rate of 20%. Okay, let's get into some specifics here, and I want to just let everybody know this is being recorded. So this webinar is going to be available. I'll be posting it to my website next week along with the slides, so you can come back and watch this. I know that some of this content is going to be complex to understand. Particularly, I had a client ask me, I'm going to be driving down the road, should I turn in and listen to this, or should I catch the recording later? It's like, well, this is going to get kind of tricky on the UDFI tax, so you might want to be sitting in front of a computer and actually looking at these numbers as we're trying to explain them. So, but I'm going to try and keep this logical and easy. I've rounded it to easy numbers so we can do the math here. But I took some sample numbers from a sample rental property of a client of mine to build this example out so you can see it. And as I told you, we've ran it through some tax returns too, so I can get you some really specific numbers and give you a good idea of how this works. All right, now let's jump into this example here. Now keep in mind, if you have questions, we're going to try and get some questions at the end. I would probably throw them into the chat window in the GoToWebinar chat window. I see there's some in there already that I am going to come back to answer. So if you do have some questions, throw them into the chat window. That might be the best way for us to address questions because there's so many people on this webinar right now. I don't think I can figure out how to find people to get people out for questions and bring them on. So if you do have a question, put it into the chat window, or it's really called the question panel here in GoToWebinar. And if you did put one in there already, I do see a bunch in there. I'm going to try and address those, so you don't need to add it in again. All right, let's get into the specific example here. Let's say I buy a property with my IRA and a non-recourse loan, and the purchase price of that property is $195,000. Let's say there's $5,000 of closing costs, so it's a total purchase price of $200,000. Now, let's say that I decide to put the 60% down, so I put down $80,000 from the IRA, or excuse me, I put 40% down, I get a loan for 60%. So there's $80,000 from the IRA, $120,000 comes from a non-recourse loan. Now I've estimated the non-recourse loan here at 5% interest at a 25-year loan term. That generates out to a $700 a month payment. And keep in mind here we have a leverage ratio of 60%. All right, easy enough so far. All right, now let's build out some actual numbers here. Let's say that the rental income on this property generates $1,600 a month, so I have annual rental income of $19,200. I built out some expenses here. We've estimated some expenses, property management expenses of $2,000, repairs, maintenance. You can see kind of how I add up those expenses. We have the mortgage interest in there. And we also have depreciation in there. So the total expenses with depreciation comes out to $17,814. Now keep in mind, a couple things are happening here. One, the depreciation is not something that's affecting your cash flow, right? That's creating an expense against this income, but you're still making that cash flow. So, and also you're paying down your loan a little bit too as you go. So the actual cash flow on these numbers is $8,356 for the year, just on the rental income. Now we have to take the total amount of income and the total expenses and apply the leverage ratio. So if I have rental income of $19,200 and total expenses of $17,814, I just apply that to the 60% leverage ratio that I had for the first year that I own this property, and we have 1 year of rental income here. That's going to take my rental income down to $11,500. I've been rounding some numbers here. Technically, the leverage ratio is like 59% because you pay down the loan a little bit, but I'm just trying to keep this easy so people can double check numbers themselves and make it easy to understand. So let's say you have a 60% leverage ratio again. You'll apply that to the annual rental income of $19,200. That makes $11,500 of UDFI income. Now I get to take all these expenses too, but I apply the 60% ratio. So I have the $17,814 of expenses, take the 60% ratio, and that brings me to $10,700 of expenses. When you run the numbers there, I then have $800 of UDFI net income. Now, one of the interesting things on the 990T and the tax return for 990s is you get a $1,000 automatic deduction off of your income. So in this example, because we were under $1,000, that is going to result in 0 UDFI, UBIT tax due, even though you had $8,356 in cash flow. So this was a rental property. It cash flowed. Your IRA made $8,300 that year on this property. You put in, again, $80,000 to buy the property. Even though you were making money on it, because you got expenses on it, and because of this $1,000 deduction there at the end, there is actually no UDFI tax due on this example. So, and this is, I think, something very common for people who have a rental property with a non-recourse loan is if they do have any UDFI tax year to year on rental income, they must be doing a great job in terms of cash flow. They're getting a lot of rent out of it, and that in that case it could generate some UDFI tax. But I just ran an actual real example of these numbers. I mean, I pulled these from real numbers and generated 0 UDFI tax. So in the final breakdown here, again, this property had $8,300 of net actual cash flow, 0 taxable income, even though there was $800 of net taxable income. But remember, you got the $1,000 deduction, so there's no UDFI tax and 0 cost for that year in terms of having the non-recourse loan as it relates to UDFI tax. Now, let's say that I ended up owning this property for 10 years. And let's say that the other 10 years looks similar to the prior one I showed you. There'll be some little variation. Maybe rental income goes up over the years. I've paid the loan down a little bit. So there could be a little bit of variation, obviously. But let's say I owned it 10 years. Now let's look at if I sold the property and how UDFI tax is going to break down. All right, let's say I have a sell price of $300,000. And there's expenses, the broker's commission of $18,000 and closing costs of $2,000. And at the time of sale, if you look at a 25-year amortization schedule, that would have put my loan balance. You remember I got a $120,000 loan when I bought this property back at the beginning. Or actually, let me jump back here. We'll go back to the actual numbers here. Yeah, $120,000 loan when I bought it. So the amortization schedule now is down to $84,000 after paying down the loan a little bit for 10 years. Now the cash return from the sale is, there's going to be $280,000. We have sales price of $300 and closing costs of $200. Now I've got to repay that loan of $84,285. Plus, if we look at the $80,000 that my IRA invested, that's going to give me a cash gain of $115,715. Now, a lot of these numbers are not helpful in calculating UDFI tax. I mean, I'm just showing this so you can see how the numbers break out. So you can see, well, what did this investment return? So on this sale, that's a cash gain of $115,715. I'm going to later come back and take out the UDFI tax so we can see how this investment performed. All right, so now what you have to do at the time of sale of a property, there's still a loan here. We have to add in back in the depreciation that was taken on the property, because over the years we took depreciation, so we have to adjust the basis here. So because we took depreciation, we're going to add back in the $63,000 of depreciation we took over the last 10 years. We had $10,000 of expenses we're adding back in for the sale. And then we have a gain of $163,000 from the sale of the property. But what's important to remember here is a couple of things are going to happen, because we got to figure out what's the leverage ratio, right? And a few things are going to happen. One is basis is going to be going down over time, right? And I'm always interested in the leverage ratio. Remember, I want to know what's the basis of the property, the adjusted basis, and what's the loan, or the average acquisition indebtedness. Those are the two numbers I need to figure out to get the leverage ratio. So the average acquisition indebtedness was 84%. The adjusted basis, or sorry, it's 84%. The average acquisition indebtedness was $84,000. The adjusted basis is $137,000. That gives us a leverage ratio of 54%. Now, we take that 54% and we apply that to the income of $163,000. That gives us $88,020 in UDFI income. I have some expenses that we get to take from the sale that we take at the same leverage ratio. So I have net UDFI net UDFI income in this example of $77,220. Now again, you get the capital gains rate at the time of sale here, which is 20%. So 20% at the time of sale is going to generate a $15,444 tax bill due for UDFI tax at the time of sale. I've had the benefit of leverage for 10 years, and I'm paying basically $15,500 in tax on this gain. Now, if we break down the numbers here to see, remember, the IRA invested $80,000 in cash. Excuse me, we had, and I kind of went back and modified these numbers a little bit to, to account for some vacancy maybe. So if we look at the 10-year period, the IRA put in $80,000. We have annual cash flow of about $7,900. I just took the same rental income. I didn't presume it increased at all over 10 years, but I added in a 5% vacancy estimate. I just want to be conservative in this number. Then we have 10 years of annual cash flow would come out to $79,380. So over that 10-year span, your IRA would have basically had $80,000 of rental income. So it doubled its money in 10 years. It put in 80 grand, it got another 80 grand in the rental income. We also have the appreciation of the property, so we have the gain from the sale, which made us $115,700. So when I add in the rental income and the gain from the sale, we have $195,000 in total cash returns, and we have UDFI tax which was paid on this of $15,400. So the amount of value there really comes out strong, and you've got a little bit of tax you had to pay of $15,000. And if rental income went up over that 10-year span, you may have been falling into UDFI tax on the rental income. It would have been negligible or low, but you're definitely paying it at the end here if there's still a loan on the property. So for having that leverage, you pay in $15,500. I don't think it's that bad of a deal to have the benefit of leveraging the purchase power of your IRA by using a non-recourse loan. Now, some of these numbers need a little rounding. You know, like I said, I try to estimate these and give some fair estimates of the numbers, but we really work these through on the tax numbers to give you a good idea of what to expect for UDFI tax. Now, I want to go over some quick frequently asked questions, and I'm going to click over here to the questions in the webinar panel. When is a 990T tax return due? So if your IRA has UDFI tax, the tax return your IRA files is a 990T. This does not go on your personal tax return. It is your IRA's tax return. That is due April 15th. Now, you can obtain a 3-month extension, an automatic extension. You have to file for that if you do not file by April 15th. Who pays the tax? Your IRA pays the tax. This is not paid with personal funds, so you have to instruct your custodian, hey, I have tax due on my IRA for UDFI tax. You'd send them a copy of the return, instruct them to send payment to the IRS from your IRA for the tax due from the 990T. Who files the 990T? Does my IRA custodian do this for me? No, it is the IRA owner's responsibility to file the 990T tax return. Your custodian does not file this for you. So this is your responsibility to file the 990T tax return. If I have losses, can I carry those forward to offset a later gain when I sell? Yes, if you have losses over 3 years, you must file the 990 to capture those losses so they can be carried forward to later offset a gain. Now, this is kind of important for people who, you have losses, so you don't have any tax due, you're not filing a 990T. You may still want to file it to carry forward those losses. If you're going to own that property over 3 years, you're going to want to go back and file, because after 3 years, you cannot go back to pick up those losses to use to offset a later gain when you sell the property. So some clients will want to go back and do that and still file the 990T if they know they're going to have debt on the property when they sell it. And that's a precaution. I'd recommend that because it'll help you build up those losses and carry them forward to offset a later gain. What are the typical fees to prepare a 990T? We started preparing these in the law firm. A 990T usually is going to run around $250 to $750 depending on the complexity of it. You know, if it was property that was held for rent, for example, those are a little bit on the easier side. If it's a property that was sold, it's a little more work. And this is obviously assuming that you have a set of QuickBooks and bookkeeping completed on this. So when you do buy a property in your IRA with debt, it's important to keep good records and some bookkeeping on that property, because you're going to inevitably have to deal with this UDFI tax. I mean, when you sell this property for a gain, hopefully at some point you're going to make money on it. Or if you're getting good cash flow on it, you may need to be filing this 990T each year on the rental income. So you need to be tracking the income and expense. Now, if you're buying real estate with an IRA and you're not using debt, it's not as critical because you don't need to worry about any of these taxes. But once you bring in the debt into the mix, this UDFI tax comes into play. As I've shown through these examples, it is not a killer tax. But you want to be tracking stuff because the expenses really do matter. As I have back in the example here on the rental, you know, I mean, these expenses are what are adding up to really cut down on this rental income you made to make sure you have no UDFI tax. But you need to be tracking those expenses so that you can properly take them. All right, I want to just talk about the benefits of leverage here, and then we'll take some questions and we'll wrap it up. Thanks everybody for hanging in on the webinar. I really appreciate the attendance. We haven't really lost a few people who have dropped off, and I have a lot of people on, so I really appreciate it. I hope you find this information helpful too. So the pros of and the benefits of leverage is, you know, a lot of clients will call me and they'll say, well, I want to buy real estate with my IRA, but the property I want, I just can't get it unless I get a non-recourse loan. So for a lot of people, it's whether they do a deal with their IRA or not, they have to have the non-recourse loan to do that deal. And so for a lot of people, it's enabling them to do the real estate deal they want to do, and they're either going to be able to do it or they're not. So the non-recourse loan bridges that gap. Obviously, that's a huge benefit. I have other clients who will say, well, I have enough money to buy one property, but maybe I'll buy two. I could buy one with cash outright, or I could buy two and use a non-recourse loan on both. And that's another great option. That's going to give you the ability to buy more property if that is a good investment strategy, and you're familiar with the real estate being bought. Obviously, the real estate you're buying matters, but so that can enable you to buy multiple properties. And frankly, that's been a question I get a lot that I've always been stumped on. And running through these numbers and seeing how the UDFI tax works as I've been starting to get into these tax returns really helps in breaking down the 990Ts and giving clients an idea of what they should expect each year on these tax returns, and do they need to stress about UDFI tax or not. And hopefully some of that mystery's been taken off here from this presentation. And again, we will have these slides available. I noticed a couple typos that I'm going to fix here when I repost them, but and we'll post the webinar as well on my website. Obviously, the cons of this is you're paying interest on the money from the bank, although rates are low now, and you're also having to pay this UDFI tax. Let's be honest, paying taxes and having to file tax returns is not fun. So, but that's, I don't want to say it's the American way, but that's just what we do in America when we make money, I guess. But again, you're not paying tax on the portion of funds your IRA is invested into the deal. It's just on the debt portion. And one strategy some people will do too is to avoid UDFI tax at the time of sale, they will pay off the loan. You just apply as much of cash flow as they can to pay the loan off. And then they will use those funds. If you look at my example here, I have back here 10 years, for example. I mean, we had cash flow here over a 10-year span of almost $80,000. And based on the regular amortization schedule over that 10-year period, I mean, I think what was the loan balance back here? There was $84,000. So if they were applying all that cash flow to pay down the loan balance, I mean, there would have been really no debt at all, or maybe only $5,000 or $6,000. So in that 10-year span, they could have paid this loan off entirely. And if they pay the loan off, hold the property 12 months with no debt, then there'd be no UDFI tax at all at the time of sale. Because when you calculate UDFI tax at the time of sale, you look at the prior 12 months of acquisition indebtedness. If the loan was paid off and there was no tax, or excuse me, no debt at the time of sale over the prior 12 months, then there's no UDFI tax to calculate at all at the time of sale. All right. Now I'm going to jump over to some questions here that are already in the chat window, or I should say in the question window. So, and Roger, as I read these questions, feel free to chime in if you'd like. Feel no obligation to do that, though, if you don't want to.
No, I'd be happy to help out, or something specific to the lending side. I'd love to. You bet.
All right. Okay, someone asked about calculating the rate of return after taking into effect the UBIT tax or UDFI tax being paid, tax prep fees. How do you calculate the return on investment? You know, I was going to try and do that actually, and of all the things I was trying to do and getting these numbers down, I didn't. But the numbers are there, obviously. So I've calculated the cash returns. You're just going to have to do some math here. Remember, the IRA put in 80 grand, and I calculated here what the total account value would be over 10 years, which this is, you know, what you started with 80 grand. You have $195,000 of rental income and gain from the sale. You would have had to pay UDFI tax of 15 grand at the time of sale. Remember, year to year, I was assuming you didn't have any UDFI tax because the first year you didn't. So the account value after 10 years would be $259,000. Now that's just from $80,000. That's not contributions or investments. That's just this $80,000 own account. So you could calculate the return on investment just from those two numbers there. I didn't actually run that number. The extension, there's a question about the extension. The extension, I have had some questions emailed to me as well, so I'll read those. The extension, you have to file for that, so you do not get a 6-month extension. For individuals and such, you can get a 6-month extension. I don't know why, but you get a 3-month extension on the 990T for IRAs. I had a question emailed to me about the tax return and what's the tax ID? Do you put the custodian's tax ID? How the tax return works? When you file a 990T tax return for the IRA, you have to get a tax ID for the IRA. Now, you never typically would do this except in this situation. So if the IRA needs to file the 990T, you do need to get a tax ID for the IRA. We can help you get that if you need to. And that tax ID is what will go on the IRA's tax return. I think a lot of people are familiar with using the custodian's tax ID, like if their IRA gets a K1 or something like that, and that's fine. But the instructions on the 990T require the IRA to obtain its own tax ID at that point, that a 990T needs to be filed, and the IRA needs to pay tax. I had another question about LLC interests. If your IRA owns in a partnership LLC with other people who are not IRAs, and that LLC owns property with debt on it, would you need to pay this UDFI tax? Yes. So what would happen is the company would do a tax return at the partnership level, and then a K1 would go to the IRA, and the IRA would then need to do this analysis we did here of its share of income that it received. You'd have to look at the debt on the property the LLC had, so you probably need a copy of the company's tax return along with the K1. And then from that information, you'd be able to prepare the 990T for the IRA. So if you do invest in a partnership doing that, just keep in mind you're going to need some information and a copy of the company's tax return, and may need to be filing the 990T year to year. All right, any other questions on, I think some of these questions in here I can see we've talked about here. Okay, there's a question about if you have the IRA LLC or checkbook control IRA, can you pay the money out of the checkbook control LLC or the IRA LLC rather than the IRA? No, the proper way would be to have, if you have the IRA LLC structure, which we had way back at the beginning of the slides, is you would, if there's no money in your IRA to pay the tax, you'd want to send the money from the LLC back to the IRA and have your custodian pay the IRA. Probably not too critical if the IRA owns the LLC 100%, but that just makes the most sense for me and would be cleanest. That way the IRS gets a check from the custodian of the IRA paying the tax out of your IRA account. Your custodian knows that's where the money is being paid for. I think that's the best way to do it. If you did pay it from the LLC before, again, if your IRA owns LLC 100%, it's probably not critical. The IRS no doubt doesn't care in terms of cashing or depositing that check. But again, the cleanest way would be to send money back to the self-directed IRA and the custodian have it written out of your IRA account by the custodian. And again, you need to send them an instruction and a copy of the tax return for them to send that out. All right. Well, we're getting up on the time here, so I'm just going to, I do have some questions that were emailed to me, and if I didn't get to your questions that you put into the window here, feel free to email me and I'll try to get back to you on your questions. I appreciate everybody tuning in today. Again, this is recorded, and I will be posting on my website. We'll send a copy to Roger. You can find it on their website as well. My website is sdirahandbook.com, sdirahandbook.com. It's on the beginning of the slides here. And I believe Roger's is myiralender.com. Is that correct, Roger?
That's correct. And you could go to our website, or you can also email me with any question, also lending specific, at roger@myiralender.com as well. and feel free to do so.
All right. Well, thanks, Roger. I really appreciate you joining me for this. Thanks, everybody, for showing up. Sorry we started late and had a little bit of technical difficulties, but like I said, we had over 450 people register and had to increase our attendee limit for the webinar, and it took gave us a little bit of delay before that went into effect. So thanks again for tuning in. I hope you enjoyed it, and we'll be announcing some other webinars later on for this year. Thanks, everyone.
Thanks again, Matt, and good luck with all you investors out there as well. I appreciate your time and the opportunity.
All right.